A strategy that we often implement when people are in the pension phase of superannuation in order to buffer them from downward market movements like the global financial crisis, for example, is to hold part of the superannuation in cash and draw the pension from that. I'll try and explain the benefit of that. So if you have a pension account, for example, and that pension account held was worth $500,000. So you've rolled from superannuation accumulation phase to pension phase and have a $500,000 in a pension account. Now, if you're over 65 or between 65 and 74 years of age, then you need to draw 5% of the balance out of that each year. So you need to draw out of that fund 5%, or in this case, $25,000. Now, if you've got that $500,000 within the pension fund fully invested in the balanced option within your super, then it is most likely, all funds are different and have slightly different asset allocations, but it's likely that it's somewhere in the range of 50% of the fund invested in equities and the other 50% invested in bonds. So equities are like shares or, all the large companies in the Australian market, for example. And then the other allocation is to bonds, which is fixed interest and cash and those types of investments. So these are defensive, equities are more growth focused. Now, so the balanced option is often 50-50, and when you draw $25,000 out of this fund, it's coming from both portions of the fund. Usually what happens is they're unitized. So you might have, for example, 50,000 units, and they might be worth $10 each, giving you the $500,000. So what happens is if you, at the point in time that you started the pension, purchased in and those units were worth $10, and for some reason the share market has dropped and it's gone down, for example, and the units therefore are worth, say, $7, this is like in the global financial crisis scenario, then if you're continuing to pull out your $25,000 each year, and depending on when you pull it out, it'll be probably varying unit prices. But say, for example, you purchased at $10 when you started the pension, and now you're drawing it out and it's worth $7. You're basically locking in a $3 loss each time you're pulling out pension payments. The unit prices varies depending on the month's valuation. So it's not likely to be all being pulled out at $7. The other option to this is, rather than having the underlying investments within the pension account all in one option, is you can have some of the $500,000 sitting in cash. So on another scenario, rather than having it all in the one option, we'll sometimes allocate a portion of the investment, and in this case we're going to say 10% or $50,000 would be allocated to cash. And the benefit of cash is that it generally just continues to grow at the cash rate. Currently that's around 2 or 3% depending on where you have that invested, but it doesn't have the volatility that the equity side of the portfolio has. And what we do is we draw out the $25,000 pension from the cash option. And so what happens in this case is that we can have the other 90% invested in the balanced option. So that can be invested in the balanced option. And so the overall equity bond ratio in this scenario ends up being, because we've got this 10% allocation to cash, 45% of, or half of the 90 or 45% is allocated to equity. So there's a 45% allocation to equity, and there's a 55% allocation to cash, or not cash, bonds and fixed interest, etc. So we're 5% more conservative by having 5% more in bonds in this scenario. But that's not the only benefit. The main benefit is that having 10% in cash, or effectively $50,000 or 2 years pension payments in cash, then when the share price or the unit price of your balanced option, when it drops down to $7, you're not actually selling any of the units at that point in time. You continue just to draw from the cash option rather than liquidating or locking in that loss when the unit price goes down. So what that should ideally do is that when the unit price goes back up again with market movements, it means that you haven't actually had to sell any of your units at that low price, because during this low period, you've been drawing from the 10% cash option. Now, most of the negative markets over the last 100 years have resolved themselves within about 2 years. Some a little bit longer, but 2 years is a standard period where markets have recovered. So having 2 years pension payments in cash mean that you're generally able to get through these negative periods. And what can happen then is that if the share price actually rises over and above what it was previously, then it might end up, or the unit price of your particular investment option, it might get up to $15, and at that point in time, your balance within your portfolio is likely to be out of whack. So your balanced option might then have 95% in it, and you might have only 5% in cash because you've been drawing from it as well. So at that point in time, it's good to move, say, 5% from the balanced option over to the cash option and replenish your cash. Now, the discipline that this creates is that you end up selling all the time at high points and not selling at these low points. So it's just an effective way to buffer you from negative markets like when the global financial crisis occurred, and enables you to only sell at high points. Now, you can make this strategy more conservative, buffer yourself further, by increasing the number of years of pension payments you're getting. So you've got stored in cash. So you could have 3 years, or up to, we say, between 2 and 5 years of your pension payments in cash. And in this case, we're drawing 5% of the $500,000 or $25,000 per annum, which means we're having between $50,000 and potentially $125,000 sitting in cash, depending on how conservative you want to be. But it enables us to then hold some equities to give us the growth that we need, so that we're getting some return on our money above the inflation rate over time. So this is an effective strategy to mitigate the risk of negative markets. It can also work well to take advantage of putting in the discipline of selling in high markets as well.